we're taking a deep plunge into a market that, well, it really seems to be defying gravity. We're talking Lancaster County commercial real estate for Q2 2025.
Yeah.
Our insights today are sourced by Chandra Mast. She's a general appraiser right there in Lancaster, Pennsylvania.
Yeah.
And she truly has her finger on the pulse of everything affecting this really unique market.
She really does.
And what becomes immediately clear as you look through these sources is that Lancaster is bucking national trends, in a really significant way across almost every single property type.
It's a stark contrast, isn't it? When you look at the national headlines about commercial real estate, they often paint a pretty challenging picture. Yet here in Lancaster, we're seeing a market on remarkably solid footing.
Solid footing. How so?
Exceptionally low vacancies, incredibly stable demand, and a very cautious, sort of deliberate approach to expansion. And that's across office, industrial, retail, and multifamily sectors.
Okay.
Just to give you some context, right? The U.S. office vacancy rate, it's hovering around, 20%?
Yeah, something like that. High.
Right. Here in Lancaster, it's closer to 3.5%, maybe 4%.
Wow. That's a huge difference.
It is. And it's not just a number,
Right.
It means businesses here are finding stable, high-quality spaces, and investors, they're seeing consistent returns in a market that, frankly, just doesn't exist elsewhere in the nation right now. That resilience, that stability, that's what we're going to try and unpack today.
Okay, that's a powerful opening. So what is the fundamental strength? What's the bedrock here powering Lancaster's real estate market to be such an outlier? Especially when, like you said, we hear so many cautionary tales about other regions.
It genuinely starts with the economic backdrop. It's really robust. Consider this. Lancaster's unemployment rate back in April 2025, just 2.7%.
2.7, that's low.
Very low. Significantly lower than Pennsylvania's 3.5% and the U.S. average of 3.9%. This ultra-low jobless rate, it translates directly to strong consumer spending and, crucially, consistent tenant demand.
It makes sense. People working, people spending.
Exactly. And we've also seen steady job growth. Added about 2,600 jobs year over year. That brings total non-farm employment to a record 268,200.
Okay, so beyond just the sheer number of jobs, how diversified is Lancaster's economy? And, why does that diversification matter so much for its real estate resilience?
Diversification is key. The county's economy is incredibly diverse. We're talking manufacturing.
Right.
Lancaster's actually a top 15 metro in the Northeast for that sector.
Didn't know that.
Yeah. Alongside strong healthcare, education, and tourism, millions of visitors flock to Amish country attractions every year.
Huge draw.
It is, and that fuels a significant part of the economy, especially retail and hospitality. Plus, you can't forget agribusiness, still a core strength, this breadth of industries. It's why local business sentiment has remained, quote, rosy, and consumer confidence here actually outperforms the national trends.
Interesting. And I see here that population growth is also playing a key role, even if it's maybe modest.
Yeah, it is. Modest but steady. The population's estimated around 560,000 in 2025. That's up about 2% since 2020.
Which is pretty good compared to the state overall, right?
Exactly. It outpaces Pennsylvania's overall trend. And, get this, with a median household income over $80,000, you have a strong consumer base supporting those retail and housing markets. But here's where it gets truly unique and critical. Lancaster's housing market.
The housing crunch.
Yeah. It's described as severely undersupplied. It boasts, and this is a quote, one of the lowest housing vacancy rates of any MSA in the country, lower than 95% of metro areas.
95%. Think about that. 12,000 units needed just to hit the national median vacancy rate. That's staggering.
It really is.
So what are the broader implications? I mean, what does such a severe housing crunch do to the rest of the market?
Well, it's not just a housing problem, right? It's a fundamental driver of demand for basically every other property type we're discussing.
Okay.
It creates these big spillover effects. It can constrain labor force growth. I mean, if workers can't find affordable places to live.
Right. That's a problem everywhere.
True. But critically, it also boosts demand for multifamily properties. People need places to rent. And that, in turn, fuels demand for neighborhood retail to serve all these residents. It's like an engine behind the low vacancies we're seeing across the board.
Got it. So this foundational strength, the low unemployment, diverse economy, steady population, plus this severe housing crunch is playing out uniquely in each commercial property type. Let's start with office space. Nationally, like we said, high vacancies, companies downsizing. How is Lancaster's office market managing to perform so differently?
It's really a remarkable countertrend. Lancaster's office vacancy, it hovered in the mid 3% range entering 2025, which, like we noted, is just way below that roughly 20% U.S. average.
And it's been going down.
Steadily declined each year since 2020.
That's fascinating. So how is it achieving positive absorption in this environment, when so many other markets are struggling just to tread water?
Yeah, we saw a rare uptick in positive net absorption in late 2024, early 2025. This was driven by several larger leases, things like medical office expansions, some corporate relocations that chose to stay within the county.
Okay.
What's crucial here, I think, is that Lancaster's demand isn't really reliant on those volatile sectors like tech or finance.
Oh, good point. More stable base.
Exactly. It's driven by stable industries.
Yeah.
Medical users, professional services, educational institutions, things like that. And landlords.
Yeah.
They've shown great adaptability, too, successfully subdividing floors, upgrading amenities to meet that growing demand for smaller suites, like those 3,000 square foot requirements you see a lot of.
Right. And with conditions so tight, what kind of pressure are we seeing on rents? Are they actually going up?
They are. Office rents are holding firm and even rising for the premium Class A space.
What are those hitting now?
Right now, you're looking at mid to high $20 per square foot, full service. And a really key factor in Lancaster's office stability is the absence of new speculative construction.
No empty buildings waiting for tenants.
No. Precisely. There's no glut of empty space pressuring vacancy rates down. New supply primarily comes from build-to-suit projects or thoughtful reuse conversions, like that former hospital campus being redeveloped into mixed use. That's a great example.
Right.
And there's also some potential for office-to-residential conversions, which, would only tighten the office supply further.
So, okay, what does this all mean for businesses actually looking for office space in Lancaster? Sounds like stable, yes, but maybe tough to find what you need.
Exactly. They'll find a stable, definitely landlord-favorable market. But with increasingly limited options, especially for large contiguous spaces, businesses will need to be agile, maybe consider a slightly smaller footprint, or perhaps upgraded space within existing buildings. The days of, abundant, cheap office space, they are certainly not here in Lancaster.
Okay, so if office defies expectations, then industrial in Lancaster sounds like it takes it even further. You hear hot sector nationally, but in Lancaster it seems practically on fire. What's driving this through-the-roof demand?
Yeah, on fire is a good way to put it. The industrial vacancy rate here is exceptionally low. We're talking approximately 1.5% to 2.0% at the start of 2025.
1.5%. Wow.
Yeah, vastly below the national average of, 7.1%?
Huge gap.
It is. And while leasing velocity might have tempered a bit from the sort of frenetic pace of prior years.
Sure.
The underlying demand for warehouse and manufacturing space truly is, through the roof. The challenge is it often goes unsatisfied just due to a sheer lack of inventory.
So companies want space, but it's just not there.
Pretty much. Specific requirements from firms like, say, third-party logistics, 3PLs, or building material suppliers, they're often really difficult to fulfill because the right kind of spaces simply aren't available.
And I assume with that kind of scarcity, rents must be high.
Absolutely soaring, all-time highs. Due to this tight market, industrial asking rents average around $6.25 to $6.50 per square foot, NN.
NN, so that's tenant pays taxes, insurance, maintenance.
Right, the standard triple net lease. And modern Class A facilities, those can even reach into the high $6, maybe low $7.
And what's driving this? Is it just demand, or is there something else going on with supply?
It's demand, absolutely, but it's also critically about what isn't happening, and that's restrained development. Unlike nearby regions, the I-81 corridor, Lehigh Valley, they saw a huge flood of warehouse construction.
Right, massive buildings going up everywhere there.
Exactly, but Lancaster's new industrial supply has been relatively restrained. Only about 500,000 to maybe 0.8 million square feet currently under construction.
Okay, why? Why is that restraint so pronounced here compared to those other areas? What makes Lancaster different?
It seems to be a combination of things. Developer caution, maybe, but also really stringent land use policies. There's a heavy focus here on farmland preservation.
That makes sense for Lancaster County.
It does. And it means any new deliveries get absorbed almost immediately. It also means Lancaster is effectively insulated from the oversupply hitting other parts of the broader Philadelphia superregion.
Right, where vacancy rates have been climbing.
Significantly.
So this raises a really important question then. How long can Lancaster sustain this level of demand with such limited developable land? Sounds like a constant balancing act.
It absolutely is. And It will likely be a defining feature of this market's future. That scarcity, it's going to continue putting upward pressure on rents, and it makes site selection very, very challenging for any new entrants. Businesses looking for industrial space here, they really need to be prepared for a competitive hunt and potentially higher cost than they might find elsewhere.
Okay. Let's turn our attention to the retail market now. Nationally, stories were often mixed, right? Closures, uncertainty.
Yeah.
But Lancaster's retail vacancy is also incredibly low. What's the secret here?
Yeah, Lancaster's retail market is described as remarkably healthy. We're looking at an exceptionally low retail vacancy rate. Again, 1.8% to 2.0% in Q1 2025.
And that's not a blip.
No, not at all. It's the culmination of a 4-year decline. Shows consistent backfilling of space, steady demand.
And what kind of demand? Is it just, grocery stores and essentials, or is it broader?
It's actually quite diverse. It definitely spans essential retail, yes.
Yeah.
But also those small shop spaces in the increasingly walkable downtowns. And importantly, tourism-oriented retail. You can't discount that.
Right, those 8 million annual visitors pre-COVID.
Exactly. That drives significant activity for outlets, the Amish country attractions, all that. Plus, we're seeing a really significant trend of mixed-use revitalization.
Mixed use, like adding apartments to retail centers.
Precisely. A prime example is the shops at Rockvale Project. They are literally demolishing part of their existing outlet retail space to make way for 480 new luxury apartments.
That's a big shift, injecting residents right into the retail environment.
Exactly. It injects new life, new customers directly into that retail environment. Feeds demand from within, you could say.
That's a fascinating evolution for what used to be a traditional outlet center.
Mm-hmm.
So given all this demand, what are retail rents doing? Still stable? Rising?
Stable to rising, yeah.
Mm-hmm.
Especially for prime locations. Downtown Lancaster City's streetfront space, for instance, that can reach $25 per square foot NN. And get this, retail cap rates, the return on investment for a property, they rose the least among all property sectors in Q1 2025, just 18 basis points.
Less than 0.2%.
Right. Which tells you investors still view the segment very favorably in Lancaster. They see strong fundamentals, stable income streams.
Okay. And that leaves multifamily, the place where everyone needs a home. It's described here as extremely tight. What does that actually mean for renters and investors on the ground?
Extremely tight is genuinely an understatement. Lancaster's apartment vacancy rates are really among the lowest in the entire nation.
Lowest in the nation. Seriously.
Yeah. Local experts suggest they're effectively in the low single digits, think 2-3%. And for quality properties, near 0% availability. Any unit that turns over is basically pre-leased immediately, often before it even officially hits the market.
Wow. So with vacancy that tight, what kind of pressure are we seeing on rents? Must be significant growth.
Oh, absolutely. Lancaster has, and this is consistently led the Commonwealth in rent growth over the past 5 years. It's outpacing even larger cities.
What kind of numbers are we talking?
In Q1 2025, effective rents rose about 4 or 5% year over year. Average asking rents are roughly $1,300 for a one-bedroom, maybe $1,500 to $1,700 for a two-bedroom.
And what's driving that specific growth?
It's multiple robust factors, really. That modest but steady population growth we talked about, strong employment growth, especially in healthcare and logistics. You've got young adults moving in or staying, downsizing seniors, the educational institutions drawing people, and crucially, a significant portion of demand is also being diverted from the for-sale market.
Because new prices are so high.
Exactly. Median home prices are around $345,000. Plus, rising mortgage rates are just keeping would-be buyers in the rental market longer.
So it sounds like there's a strong push for new supply, right?
Mm-hmm.
Are those efforts making a dent? Is it enough?
Efforts are certainly underway, and they're significant. You have projects like that former hospital site redevelopment that's already delivered 64 affordable units with more planned.
Okay, good.
And of course, the Shops at Rockvale project, adding those 480 luxury apartments, that's a big number. However, despite these notable efforts, new supply is still just not keeping pace with the overwhelming demand.
It's all falling short.
Yeah. And things like zoning, sometimes community opposition, they can slow down development too. So it's really an uphill battle to truly alleviate the shortage and address that critical housing affordability challenge in Lancaster.
Right. Okay, so given all these really strong fundamentals, we've discussed the low vacancies, rising rents, robust demand. What's the investment landscape like? Who's buying in Lancaster County CRE right now?
Well, investment activity definitely picked up significant momentum coming into 2025. Just as an example, regional industrial sales volume was up 82% year over year in Q1 2025. That's a big jump.
82%. Wow.
Yeah. And industrial and multifamily properties, they are truly highly sought after, kind of the white-hot assets for both local and national investors.
Any specific examples?
Sure. We saw an industrial portfolio trade at around a 6.5% cap rate recently, and a 120-unit apartment community sold at a sub 5% cap rate.
Sub 5% cap for multifamily. That shows really strong confidence, doesn't it?
It really does.
So where is this capital coming from? Is it mostly local, or are outsiders coming in?
Increasingly, capital is flowing in from outside the area. We're seeing investors from places like New York, North Jersey.
Why Lancaster for them?
They seem to be attracted by the stability, and maybe better yields compared to what they can get in the primary cities right now. Local banks are also very active lenders. They have deep market knowledge, obviously. And we're seeing well-capitalized buyers like family offices, private equity firms. They seem to be making strategic long-term holds.
And what about cap rates overall? You mentioned some examples, but where are they sitting generally?
Well, they are slightly higher than maybe a year ago, mainly due to interest rates moving up, but they remain relatively tight compared to historical averages and certainly compared to other markets. For Q1 2025, the rough ranges are industrial around 6-7%, multifamily, like we saw, 5.5-6.5%, retail maybe 6.5-7.5%, and office perhaps 7-8%.
So still pretty compressed, considering.
Yeah.
What stands out to you personally about how investors are viewing Lancaster, like as this unique opportunity in the current market, especially given the wider economic uncertainty?
What's truly fascinating, I think, is that despite all those broader economic uncertainties, Lancaster is really seen as a kind of safe harbor.
Safe harbor.
Yeah. Investors seem drawn to the predictable, strong fundamentals. The low vacancy, the consistent rent growth, that diverse, resilient economy we talked about. There's maybe just less speculative risk here compared to other places, and that makes it appealing for those seeking stable, long-term returns. Even if it means slightly lower initial cap rates compared to, say, higher risk, higher vacancy markets. Yeah. It's really about stability and consistency in what feels like a pretty unpredictable world right now.
Okay, so to try and wrap this up, Lancaster County's commercial real estate market, as we head through 2025, it's a robust and incredibly resilient environment. High occupancy, rising rents, active investment across all major property types. And it's largely due to these really unique supply-demand dynamics and a profoundly strong local economy. But of course, no market is perfect. There are challenges. We touched on the labor shortages, the critical housing crunch, maybe some infrastructure constraints too.
Indeed. Those are real challenges. But, Lancaster's approach, it's deliberate, it's careful growth, it tries to balance that economic expansion with vital farmland preservation, and there's a highly engaged community planning process. All that has created a truly distinctive market, and maybe raises an important question for you, the listener, to consider.
Okay.
Can other growing regions actually replicate this model of managed growth? Can they foster similar resilience and stability in their own commercial real estate sectors? Or is Lancaster just simply too unique in its local dynamics, its history, its culture, too unique to be easily copied elsewhere?
That is a compelling thought to ponder long after our conversation ends. A great question. Thank you for joining us on this deep dive. If you'd like to explore these insights further and maybe connect with the expert behind these valuable